Hi everyone, welcome to the Real Estate Tax Tips channel. My name is Cherry Chen, a chartered professional accountant and a real estate investor located in Ontario, Canada. My mission is to become the Google map for hardworking Canadians seeking financial freedom. And today's topic is about interest rate. Bank of Canada just announced a rate hike of about a quarter of a percentage point last week, despite the Russian and Ukraine war. We have been speculating about this rate hike for almost half a year. We knew it was coming. We just didn't know how much the interest rate hike is going to be and how it would affect the real estate market or the stock market. So today, we will discuss in detail the background of the interest rate hike and the 5 things that you can do as real estate investors to handle this past rate hike and the future expected hikes as well. Every week, I send out an email about money saving tips and real estate tax tips, all designed to help you build your long-term wealth and live life on your terms. The email takes 5 minutes to read and over 10,000 Canadians get it. Think you'll like it. Sign up using the link below. Now let's get started with some background information on interest rate hikes. In the past 2 years, the Canadian government had done 2 things to help fellow Canadians to pass this tough pandemic time. Number 1, lots of subsidies, grants, and benefits were offered to local businesses and fellow hardworking Canadians to help them with this tough pandemic time. Number 2, the Canadian interest rates have been lower to the historic level at 0.25% to stimulate borrowing and investing. Our government has been incurring a substantial amount of deficit year in and year out, even before the pandemic emergency relief measures. You can see from the chart the past 4 years of deficit that our government have been running on. With the unprecedented amount of benefits and subsidies offered during the pandemic, the federal government had increased their deficit by 12-fold, by $274.4 billion in 2020. If you combine the federal government deficit with the provincial, territorial, and local governments, the consolidated deficit was $325.5 billion for 2020. Have you wondered how the Canadian governments altogether can afford to have this much deficit in 1 year? And have you wondered how they finance this type of expenses even though they don't really have the money in their bank account? For regular people like you and I, if we have to incur some sort of a deficit, we have to borrow from our families and friends or even the banks. But how would the government, the Canadian government as a whole, finance their spending? Well, the simple answer is that they borrowed. They borrowed from the Bank of Canada. So how does the Bank of Canada find money to lend it to the government of Canada, which then turn around and provide all the subsidies and everything to the general public? It's through a process of auction and asset purchase. Now, according to the Parliament website, the Bank of Canada helps the Government of Canada borrow money by holding auctions throughout the year at which new federal securities, so new debt, are sold to the government security distributors such as banks, brokers, and investment dealers. And through this process, Bank of Canada also hold a bunch of these assets in their own name as well. When these bonds and debt being issued by Government of Canada to the Bank of Canada, which then auction off a bunch of them to the banks and also brokers and investment dealers, they record a new and equal amount of the asset and liability size of its balance sheet, creating the money through the digital accounting entries. So literally, it's just a debit, assets, and credit liabilities. For those of you who have some accounting background, it's an adjusting journal entry, essentially being done as debit, assets, and credit liabilities. And the federal government can then spend that newly created money in the Canadian economy as it sees fit, subject to Parliament's approval. And the creation of money by the Bank of Canada through the purchase of assets like Government of Canada securities has fundamentally the same financial impact as the bank making loans to the federal government, or in another word, as the Bank of Canada printing money. And this is how they create extra money in the money supply system to finance all these benefits programs and grants program to help Canadians pass through this tough time. With an increase in money supply over the last 2 years, as well as low interest rates offered by the Bank of Canada, it isn't surprising to see that inflation surpassed 5% in January of 2022. As real estate investors and homeowners, you probably had all seen and heard about the recent crazy real estate market boom, partly stimulated by the cheap money offered by banks. One of the ways that the Bank of Canada can limit the inflation and control the overheated housing market is to increase the prime rate. So they did. They announced a rate hike of 0.25% last week. And now the new Bank of Canada prime rate is at 0.5%. And we're expecting to see more. Increasing the prime rate means that the cost of borrowing is higher for everyone. We are less likely to borrow to invest, to purchase our next home or our next investment property. Interest is higher and therefore we can afford less in terms of housing cost. Increasing the prime rate also means that the cost of borrowing is also higher for the Government of Canada. Remember, Government of Canada finance their spending by borrowing. So the cost of borrowing is going to be higher for the Government of Canada as well. So keep that in mind. Now that we've got the background of how the interest rate works in Canada and why the Bank of Canada intended to increase the interest rate, as real estate investors, you may wonder, how do we as real estate investors would be able to prepare ourselves for these inevitable rate hikes? Well, we all knew that this was coming. We just didn't know how much increase we would see over the next year or so. The good news is that the gradual increase in interest rates over the year to help slow inflation does not mean that the property prices of our investment properties will stop rising. The prices of the market may take some time before they stabilize. Inflation will most likely increase even further in the near future before things start to slow down again. Now, here are the 5 things that you can do to counteract the impact of this interest rate hike. Number 1, lock in with fixed interest rate mortgage. If you're a real estate investor, you already know the difference between the variable rate and fixed rate mortgage. But if you are just starting out as an investor, you should know with a fixed rate mortgage, your interest rate and payments stay the same over the mortgage term. Fixed rate mortgage is tied to bond rate, not Bank of Canada prime rate. With a variable rate mortgage, the interest rate can move up or down according to the lender's prime interest rate, which is also tied to the Bank of Canada prime rate. What this means with a fixed rate mortgage is that you'll know when you'll be able to pay off your mortgage as the interest stays the same over the term. You'll be able to confidently budget for mortgage payment, know exactly how much you have to pay on a monthly basis. You can expect the initial interest rate to be a little bit higher than the variable rate mortgage. You can also expect to be locked into your interest rate for your entire mortgage term or pay penalties if you choose to break the mortgage. The biggest downside of locking in a fixed rate mortgage is the cost of the penalty if you were to sell the property early or if you were to choose to refinance the property and break your initial term of mortgage. The penalty is often calculated as the greater of 3 months of interest expense or interest rate differential between your existing mortgage or the current bank's advertised rate or posted rate. From my personal experience, this could amount to tens of thousands of dollars in terms of penalty if you choose to break your mortgage early. When you commit to a fixed rate mortgage, make sure you're not planning to 1, sell, or 2, refinance within the term of your mortgage. Otherwise, you'll be incurring tens of thousands of dollars of penalty. With a variable rate mortgage, however, your initial interest rate will most likely be lower than a fixed rate mortgage. If the prime rate falls and your interest rate falls accordingly, your monthly mortgage payments decrease as well, and vice versa as the prime interest rate has increased and is expected to continue to increase. If the prime rate rises and your interest rate goes up accordingly, your monthly mortgage payments increase as well. You can convert to a fixed rate mortgage at any time, especially when you know there's going to be an expected hike in interest rate. Now, here's the little hack that I normally do to counteract the disadvantage of fixed rate mortgage. I normally commit to a variable rate mortgage, but then I pay fixed rate mortgage amount. Let's use an example to explain. If I were to borrow $800,000 today from the bank to purchase a rental property, I would opt for a variable rate. Variable rate right now depending on who you talk to, let's use the example of about 1.6%. The variable rate at 1.6% means that my monthly payment on the $800,000 mortgage is about $2,797. Now, if I were to commit to a fixed rate mortgage at 2.69%, this means that my monthly mortgage payment would be $3,234. For those investors who want peace of mind that their monthly payment won't go up in the next few years, here's what I would do. I would sign up for the variable rate, but increase my monthly mortgage payment amount to the fixed rate mortgage payment amount. With an $800,000 mortgage, the bank requires me to pay about $2,797 if I go variable on a monthly basis. I would instruct the bank to make a payment of $3,234 instead. So I'm already using the higher monthly payment amount as if I were paying a fixed rate mortgage. The extra $437 payment that I make goes toward paying down my outstanding mortgage on a monthly basis. At the end of 1 year, my mortgage outstanding amount is lower by $5,306 as compared to opting in for the fixed mortgage. My cash outflow is exactly the same, but the extra goes straight to my mortgage principal paydown, which also carries a compound effect on my monthly mortgage payment. By the end of the second year, assuming there is no rate increase, my mortgage outstanding is lower by $10,757 cumulatively. If you are concerned, go for the variable rate mortgage, but pay as if you are committed to a fixed rate mortgage, assuming you have the option to do so. Number 2, invest in cash flow positive properties. We always invest in cash flow positive properties. That's my own investment principle. If the rental income isn't enough to cover all expenses on its own, we would not consider buying that particular investment property. As a minimum, we need to generate enough cash flow from our overall portfolio to support this cash flow negative investment. With this principle in mind, even if there is a rate hike, your overall portfolio can still sustain itself without further cash flow injection from you. Yes, you can still find cash flow positive properties, you just have to look harder and be more creative. We bought a couple of properties in the 2017-2018, just before the market downturn. We bought at the peak that year. I remember questioning myself, why did we commit to purchase these properties when they were priced at the top? Well, thankfully, they have been cash flowing positive from day one, even though we bought them at the peak. Fast forward to 2022, these properties continue to provide strong cash flow and they have the least loan to value ratio among our portfolio because the property has gone up substantially. So make sure that you follow this particular principle when you purchase your next investment property. Number 3, restructuring debt to seek out lower cost of financing. Never stop finding lower costs of borrowing. Mortgage and debt carrying costs are generally the biggest expense when we operate our real estate rental portfolio. As we speak, we're in the middle of refinancing 3 of our investment properties. We're trying to convert these mortgages to line of credit instead. Instead of paying a blended mortgage payment as required under the mortgage repayment term, if we were able to successfully convert them to line of credit, the line of credit allows us to pay interest only, lowering the monthly debt carrying cost. If that plan goes well, we're hoping to switch our B lender financed properties to these line of credit as well. Imagine switching from a B lender mortgage to a line of credit with interest only payment. We can easily increase our cash flow by $1,000 or more for each property. We will still use the excess cash flow saving to pay down our debt, but we get to choose the amount that we pay. Even if interest rates goes up, we get the flexibility to pay less into our principal payment, maintaining the same level of cash flow monthly. Make sure you constantly look out for lower costs of borrowing to minimize the biggest item in your rental portfolio. Number 4, take advantage of the dip. You have probably heard about the quote by Warren Buffett, "Be fearful when others are greedy, and be greedy when others are fearful." When there are multiple hike increases, we expect to see a price adjustment in the real estate market. It may not be a dip at all, it may just be the market slowing down. This can be the perfect opportunity for capable investors to enter the market, take advantage of this slowdown. Remember the market downturn in March 2020 when nobody else was buying properties? Hindsight is always 2020. Number 5, relax, rates will remain low for a very long time. From the narrative on Statistics Canada's website regarding the 2020's government's debt level, the government's overall liability level, they said our debt charges, essentially the government of Canada's interest expense, remain low despite record debt levels. This is a result of increasing money supply, encouraging lending and investment, and keeping short-term interest rate close to zero. This allows our government to finance the unprecedented deficits generated during the pandemic at low cost and to refinance maturing debt at lower rates. Now, the flip side of this narrative is that when the Bank of Canada increases its prime rate, which is right now, coupled with the stop of quantitative easing that they've been doing, means that the government will have to finance their future deficit and their future refinance of their debt at higher cost of interest. Remember, when the Bank of Canada increases its prime rate, it's also increasing the interest expense that the government of Canada is paying. The government of Canada has about 2,852 billion of total liabilities as of 2020. A rate change is going to increase the cost of financing, not just for us, but for our government as well. Yes, the rate is likely going to increase again to tame the inflation, but no, it won't have a substantial increase like back to 23% in the 1980s or even back to 8% in the 1990s, or else our government can go broke. As the interest rate continues to hike, it is predicted that people will be able to borrow less. This when you, as a real estate investor, should be considering growing your real estate portfolio. A proper corporation structure can help you minimize the amount of taxes. So make sure you speak to our team to book a consultation to help you minimize the amount of taxes that you would need to pay. Now that we've covered the background of the interest rate and the 5 steps that a real estate investor can take to prepare yourself for the upcoming rate hike, make sure that you hit the subscribe button and turn on the little notification next to it. And if you have any comments about the interest rate hikes, leave it in the comment section below. Until next time, happy Canadian real estate investing.